So we are going to talk about bull spread using calls, and it's a fancy name, but basically we have an expectation that an underlying asset is going to go up. So we're bullish, and we want to buy a call option, but we want to do it with a spread. So the lecture notes actually explain what this is, but it's actually pretty simple. So let's go through. The first 2 weeks, you have actually purchased a call option. Those of you chose to do the call option. So let's say that we have an expectation that the market is going to go up and Apple is going to go up. And I'm again picking on Apple, shocking. So the current price of Apple is $247.74, and we are expecting Apple to go up. Let's say that our expectation is that Apple is going to, so expectation is Apple is going to go above $250. And we are expecting this to happen pretty soon. This is our expectation. And again, for the sake of this video, not a financial advice. So if this is our expectation, then to cash in on this expectation, we will buy a call option with our paper money account. So let's take a look. Basically what we're saying is we are thinking that Apple is going to be around that $250 level. So let's draw a little, yeah, close enough. So we'll do something like this. So that's where we're expecting the price to go above. Now, I'm using tradingview.com, a free website that actually shows you and gives you some technical analysis tools. So let's take a look. For April the 3rd, so our maturity will be April 3rd, and the strike price will be $250. So let's take a look. And unfortunately, they don't have a price. So the last price is $9. Let's use that. Last traded price is $9. So the price is $9. Now it's a rather expensive option because for one contract, the cost for one contract would be equal to $900. That's a lot of money. So I don't feel like paying this much for this expectation. I mean, for us to make any money on this, Apple needs to go above $250 as much as $9 so that we could cash in and make some profit above and beyond what we're paying for this option. So we're going to be, so let's say that Apple went to 260. We already paid 259. If Apple goes to 260, then we make $1,000 profit. I mean, $1,000 income, but our cost was $900. Therefore, our profit will be only $100. So we have actually risked $900 to earn a profit of $100, and that's not really ideal. So what are we doing exactly? When you buy a call option, you're buying it so that if the price is anything above and beyond this level, you'll make a profit. So if we have a strike price of 300, if we have a strike price of 250 and the underlying asset actually goes to 300, then we could exercise this option and make a $50 exercise value. And I'm not even talking about the premium. You have an exercise price of $250, and if Apple goes to 300, just your exercise value will be $50. And that's tremendous amount of profit. Or, if it actually goes to 320, well, our strike price is 250, and if Apple goes to 320, then we'll be making $70 only in the exercise value. And I'm not even talking about the premium. However, how likely is it? How likely is it that the price is going to continue above 260 to 270 to 280, 290, 300, and so on by Friday's closing? And so then let's do a spread. So we will buy a call option, maturity April the 3rd, strike price is 250, price is 9, and this is how much it's going to cost us, which means anything above 250, we're making a profit. But we're saying that while we expect Apple to go above 250, what if we don't expect it to breach 280? Then can we do this? Let's say that, let's take a look at 280. There's a 65 cents. It's too cheap. Let's make it 265 right there. That's about $3. 297, about $3. I'm going to call it 3. So we will then write a call option. Maturity will be the same, April the 3rd. Strike will be 265, and then price will be 297, and then the cost for one contract will be $297. So, but notice what we're doing here is we're writing this one. Now, we're buying the call option at 250 strike for April the 3rd. Then we are writing a call option with the same maturity of April the 3rd, with a strike price of 265, with a price of 297. Now, this is the price that we pay, and this is the price that we collect. Therefore, total cost then is the $900 that we pay, and then $297 that we collect. Then the cost will be $603 that we pay. Now, what did we do? We bought a call option at 250. Anything above and beyond, we make money. Then we wrote a call option at 265, right there approximately, right? Oops. That's about 265. Well, and then this one, let's extend it a little bit more. So this is the one that we bought, and this is the one that we wrote. Now, we bought this one, which means anything above and beyond, we make a profit. We wrote this one, anything above and beyond, we lose. Now, since we have them both, if the price goes to 300, we make money with the one that we bought, and we lose money with the one that we wrote. However, if the price is right in between, then we make money with our call, while we only collect the premium without encountering an additional loss. Which means that if the price is between 250 and 265, we make a profit. What happened, in effect, is that we limited how much profit we could make. And again, realistically thinking, what is the likelihood that Apple is going to do by Friday's closing? I mean, it could go up to 65, go above that. I mean, but what is the likelihood? If we don't see that likelihood to be high, then why don't we just buy a call option at 250 and then write one right there, which means that from 250 to 265, $15, we could make a profit. $15, 100 shares is $1,500 of a profit that we could make. Now notice, if we only buy the naked call, the cost for us is $900. However, when we write a call option, we collect the option price because we're writing it. And since we're collecting $297, then our overall cost for the spread, when we do them both together, it's called a spread, vertical spread, then the cost for the spread will be $603. Now, if we own just the call option, we have an unlimited profit opportunity, but it costs us $900. When we do a spread with the 265 by writing a call as well as buying a call, then we limit our profit to $15 per share. However, the cost goes down to $603. So the only reason we're doing this as a spread rather than a naked call buying is because with a spread, you have a lower cost. You limit your profit, but you have a lower cost. So let's do a simple spreadsheet and let's talk about it just to see what could be the outcome. So we have a buy. Strike price is 250. And then we are writing at 265. Now again, we paid 900 for this, and then we received 297 for this, and therefore our overall cost is $603. Now let's say that price on April the 3rd is $300. So the profit on this one, on the one that we bought. Now don't forget, this is a call option. So since our strike price is $250 and the price on the closing of April the 3rd is $300, our profit, just the exercise value, will be the $300 minus the strike, which is $50. Now, how about this? Now, the one that we wrote, the 265, well, again, it will be $300 minus 265. However, this is the one that we wrote. Since we're writing this, this will be our loss. Now, the overall will be then the profit of the first that we bought, and then, the profit of the first we bought, and then the loss on the one that we wrote, and that's a $15 profit. Let's say that again, the price on the same date is, say, I don't know, $400. Again, the profit will be 400 minus the 250, $150, and then the profit, or rather the loss, is again 400 minus 265, which makes it 135. And then what is our profit? $15. Now notice, if the price on April the 3rd is, say, $200, then the profit would be, the one that we bought would be 0, and then the one that we wrote would also be 0. So the cost will be then $600 instead of just buying the call at $900. So the only reason we're doing a spread is to make the strategy cheaper. Rather than just buying a naked call and paying the $900, we're buying the call and writing a call, and therefore we get paying the $900 and then collecting the $297, and therefore lowering the cost of our expectation. So if you look at this, you could actually move this up if you wanted to, but then it would cost us more. So if you move this to 270, well, then we have the profit range of 250 to 270, and that's a $20 range. But then the how much we're going to collect will be $1.90. So instead of, so we make this 270 and then $1.90. So $1.90 and then $1.90. So it's $710. As you can see, we can increase the range, but you would actually have to pay a little bit more. Now we can even increase it more, say to 80, right there, as you can see. But the problem with the 280 is it's only 65 cents. At that point, I'm not sure if it's worth doing a spread. We might as well just do a call option, a naked call, and we could just buy it and then get it over with. So the only reason that we do a vertical spread, and this is what it is, a vertical spread, is to make it cheaper. But notice, this is an example of what we call a debit vertical spread. On another video, I'm going to talk about a credit vertical spread, and that's totally different. A debit vertical spread, we're basically still paying. We're still buying a naked call. However, by writing a call that's above, we're converting our naked call into a vertical spread just to make it cheaper. There's really no other motivation behind it, just to make it cheaper. So the assignment, or one of the assignments, is bull spread using calls, meaning that we have an expectation that the market is going to go up, and therefore we're going to buy a naked call, and then we are going to write a call to convert that naked call into a vertical spread. But we're still betting on the market going up, and we're still paying money. We're just paying less for it. So rather than $900, we're going to pay either $600 or $700 and make it a little cheaper, but that also takes away from our possibility of a profit. But having said that, that's why we call this a bull spread. And since we're using calls, bull spread using calls. Vertical spread, a debit spread simply means that we're paying still for this strategy. So anyways, we're going to talk about the bull spread using puts on a separate video, and that's it for this one. Thank you, and let me know if you have any questions. Bye.